It's August 2026. The S&P 500 and the Dow are sitting near record highs. The Fed has held interest rates at 3.5 to 3.75% for months. Oil prices are swinging on Middle East tensions. And every finance channel on this platform is telling you something different about what to buy. So here's the question I get asked the most. If I were starting from zero today, new account, no positions, what would I actually put my money into? That's what this video is. Not hype, not a stock tip. A framework, plus the specific building blocks I'd use and why. Let's get into it. Before picking anything, you need to know the environment you're stepping into, because it changes how much cash you hold and how fast you deploy it. 3 things are true about the market right now. First, valuations are elevated. Major indices are near record highs, but market breadth has weakened, meaning fewer stocks are actually pulling the index up. That's a classic late cycle signal, not a crash signal. Second, the Federal Reserve has kept rates steady in the high threes for months, with real disagreement inside the committee about the next move. Inflation ticked up earlier this year on energy prices tied to conflict in the Middle East, so the path to rate cuts isn't guaranteed. Third, corporate earnings this quarter have been a story of winners and losers. Companies that beat expectations are getting rewarded hard, and companies that miss are getting punished hard. That's a market that's paying close attention to fundamentals, not just riding momentum blindly. None of that tells you to panic. It tells you to be deliberate. If I'm starting from zero, the first dollars don't go into a hot AI stock or a single company I read about on social media. They go into the boring stuff first, because the boring stuff is what actually compounds over decades. Layer 1. A total U.S. stock market fund or an S&P 500 fund. Something like a broad market ETF that owns hundreds of companies at once. Think funds tracking the S&P 500 or the total U.S. market. Why start here? Because you're not betting on one company's earnings call. You're betting on the productivity of the entire American economy over time. Historically, that bet has paid off far more reliably than picking individual winners. Layer 2. International exposure. It's tempting to go all in on U.S. tech right now because that's where the AI story is playing out. But a portfolio that's 100% U.S. stocks is a concentrated bet on one country's currency, politics, and interest rate policy. A slice of international developed and emerging market funds, even just 15 to 25% of your stock allocation, smooths that out. Layer 3, and this one matters more in 2026 than it did a few years ago: bonds or cash equivalents. With the Fed funds rate sitting around 3.5 to 3.75%, you're getting paid a real yield to hold something safe again. That wasn't true for most of the 2000s and 10s. If you're investing for anything shorter than a 10-year horizon, or you just want ballast against volatility, short-term treasury funds or a high-yield savings vehicle are earning meaningfully more than they used to. So let's make this concrete. If I opened a brokerage account this month with, say, a long time horizon, 20+ years, here's roughly how I'd think about splitting new contributions. This is illustrative, not a recommendation for your specific situation. 60 to 70% into a broad U.S. total market or S&P 500 index fund. This is the engine. 15 to 20% into international index funds, developed markets like Europe and Japan, plus some emerging market exposure. Valuations outside the U.S. have generally been cheaper, and it hedges against U.S.-specific risk. 10 to 15% into short-duration bonds or a money market fund. At today's rates, that's not dead money. It's earning a real return while giving you dry powder to buy more stocks if there's a pullback. And here's the part people skip. Only after those 3 buckets are funded would I consider a small satellite position, maybe 5 to 10% of the total portfolio, no more, in a specific theme or sector I have genuine conviction in. Right now, that theme is obviously the AI buildout. Semiconductor companies, cloud infrastructure providers, the businesses actually supplying the picks and shovels of this expansion. Analysts at major firms have been projecting well above trend earnings growth for the S&P 500 over the next couple of years, largely credited to AI-driven productivity and enterprise adoption. That's a real tailwind, but it's also the most crowded trade in the market, which means it's also the most vulnerable to a sharp correction if even one major earnings report disappoints. And we've already seen that happen this year with sharp single-stock sell-offs on minor misses. Just as important as what to buy is what to avoid, especially given where we are in this cycle. I wouldn't go all in a single lump sum on one day, especially into narrow, high-momentum trades. We've literally just watched a prominent AI-focused hedge fund unwind large positions after big losses earlier this summer. A reminder that concentrated, leveraged bets on a hot theme can turn painful fast, even when the long-term thesis is right. I wouldn't chase newly public, highly volatile stocks based on retail hype alone. There's been a lot of retail enthusiasm around certain recent IPOs this year, with individual investors buying the dip nearly every single day despite big share price swings. That kind of stubborn buying can work out, or it can mean a lot of people are anchored to a story instead of the fundamentals. And I wouldn't ignore the geopolitical backdrop. Oil prices have been whipsawing on developments around Iran and the Strait of Hormuz. Energy shocks have historically been one of the fastest ways to reignite inflation and derail a rate cut cycle, which in turn hits stock valuations. It doesn't mean stay in cash. It means keep some dry powder and don't assume this rally is a straight line up. Here's the strategy I'd actually use to deploy money, regardless of which specific funds I picked. Dollar cost averaging. Instead of dropping a full lump sum in on one day, especially with indices near record highs, I'd split it into equal chunks and invest on a fixed schedule, say monthly, over 6 to 12 months. Why? 2 reasons. Psychologically, it removes the pressure of trying to time the exact bottom, which nobody consistently does. Not professionals, not algorithms, nobody. Practically, if the elevated valuation, weak breadth environment we talked about earlier does lead to a pullback, dollar cost averaging means you're buying some of your shares at lower prices automatically, instead of having deployed everything right before a dip. If you're investing through a 401k or automatic contributions from every paycheck, congratulations. You're already dollar cost averaging. That's one of the most underrated advantages of employer retirement plans. Everything I've described assumes a long runway. Think retirement account money you won't touch for 15, 20, 30 years. Your actual allocation should shift based on when you need the money. If your horizon is short, under 5 years, say you're saving for a house down payment, I would lean much more heavily into that bond and cash bucket because you can't afford a bad 2 years right before you need to withdraw. At today's yields, sitting in safe, interest-bearing instruments is a perfectly reasonable place to park short-term savings. It's not wasting the money. If your horizon is medium, 5 to 15 years, something closer to the 70-20-10 stock-bond split I outlined earlier makes sense. If your horizon is genuinely long, you're in your 20s or 30s investing for retirement, you can afford to lean even more heavily into stocks because you have decades to ride out volatility like what we're seeing in momentum stocks and rate-sensitive sectors right now. If you remember nothing else from this video, remember this. The specific ETF ticker, or the exact percentage split, matters far less than 2 behavioral things. Starting now, instead of waiting for the perfect entry point, and staying invested through the inevitable rough patches instead of panic selling. Markets near record highs feel scary to enter. But markets have hit new record highs constantly throughout history, and investors who waited for a better time have historically underperformed investors who just started consistently on a schedule. August 2026, with its mixed earnings, its rate uncertainty, its geopolitical noise, it's not a uniquely bad or uniquely good time to start. It's just a time. There will always be a headline to be nervous about. So, to recap what I'd actually do if I were starting today: broad market index funds as the foundation, some international diversification, a real allocation to bonds now that they're paying real yields again, a small satellite position in the themes I believe in, and all of it deployed gradually, not in one lump sum, matched to my actual timeline. This isn't a stock tip video, and it's not personalized advice. Your situation, your risk tolerance, and your timeline are yours alone, so talk to a licensed advisor if you want something tailored to you. But if you want the framework I use to think through any market environment, hit subscribe, and I'll see you in the next one.